Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Intuit, ticker INTU. You might know them from TurboTax, Credit Karma, QuickBooks, MailChimp. They have quite a few different platforms that they offer as a SaaS business, almost conglomerate, helping small businesses, mid-sized businesses. I had noticed on my list of ranges that they were at a value based on the last time we looked at them, where it would be worth purchasing. And it had been a little bit since we last took a look. So I wanted to look things over again and see, is it truly worth purchasing? Has the fair value gone up? And what some of the growth prospects are. If the growth rate is going to hold at the high level that it was at. Jumping right into this, the values are all over the place with such insane growth. So fair value is 534, almost 535, with a discounted cash flows of 422. But when we go look at some of the metrics, they're growing so fast. I mean, back in 2021, the fair value was $251. Projections for next year, if they come in on par with analyst expectations and the growth rates that we put into our thesis, then 688 is the fair value for next year. So that's getting dragged down by some historical values because it's making massive leaps, and also the discounted cash flows. So I do think that this is worth a premium, especially with what we're coming up with for the growth rate. So earnings yield looks super low, 2.22. We'd want $30. I think 28 is next year's expectation. Cash flows are decent, 28.4 on average, 30%. Dividend yield's a little low, but their payout ratio isn't too high. It's right at the cusp of what we like to see, that 30 to 50, and they're growing it really quickly too. So this could become a bit more of a dividend stock, awarding shareholders in the future. ROE looks good, 16.09. Debt to equity is not too bad, 0.74. It is under 1 where we like to see it. ROI, 9.31, and ROA, 9.22. So I like the returns. I like the cash flows. Not crazy for the dividend, but it's not really a dividend stock. They've got so much growth. And also their returns are so good that they don't need to be diverting cash to reward shareholders and give a dividend. It's rewarding enough for them to grow the business as they are. Gross margins super strong, on average 80%. This last year 78.5. Net was up a little bit, 18.16, on average 18.1. So PE seems a little high, 30.77, but when we take a look at the metrics, it's lower than what we've seen historically. From 2021 to 2025, it looks like they're hovering somewhere between a 40 and a 60 PE. So 30 is actually pretty low for them. And PEG of 2.16, so definitely overvalued on the earnings front. Traditionally, we're looking for that to be around 15. It's way over that. And the PEG, we like to see it under 1, which means there's some really strong growth baked in, even with it being $100 a share below its peak in the last year. It was 715, it's currently 615, and it's gone as low as 533. Well, the thesis isn't too difficult here. In fact, 12 might be a little low. I don't know what it's going to be like after these 2 years, but 12.7, 12.5, analysts are consistent with that, so we're going to use 12 for the revenue growth. Share count, I'd like to see it flat. I mean, this last 2 years, they bought back some shares. 3 years ago, they issued some, though. So hopefully they stopped the issuance, and if they're buying back less shares, lower share price, then we might see something in the realm of 0.25% again. And we can update things to see how that affects the results. Cash flows, I want them a little above revenues because they are below average on cash flows, and it is something that's kind of dragging them down. As crazy as it is to say, but they just don't have massive growth in those cash flows. Assets, last 2 years, 5%. We'll stick with that. Liabilities, 6.6 for the last 2 years. We'll go with 6 for the thesis. Dividend, of course, it's going to come down a bit. Higher dividend to start with. I mean, if they can get 8%, that brings them to $5 in 5 years in dividends. And then at that point, you'd be getting a yield on cost buying today of 0.8%. So again, definitely not a massive dividend stock here. And I had to update my formula here, but this shows that you are expecting a market outperforming return in the next 3 years and in the next 5 years. You're beating out the market by 1% in the next 3 and 9% in the next 5, as long as this holds true. And that gain is based off today's share price. I mean, if you got in at the 532, you'd be looking really, really good. So outperforming by 21% in the 3-year and by 44% in the 5 years. So very, very good returns for someone who bought down at the 530 level, which is where the fair value is at. If they had run through the numbers, set their target price at the fair value, or maybe even a little bit lower, I mean, could have sold puts lower and made a bit off premiums. But that is why we run the numbers and find what a reasonable price for our own portfolios is. So everything is going to look great here. I mean, there is no complaints about really anything here. Balance sheet growth. Assets aren't tangible. I mean, they're almost to the point where they will be. I wouldn't be surprised if they ended up with some tangible assets this year, and that could get them going on a tangible book value as well. Cash flow strong. Definitely dipped down in 2024, like we saw, was below average. So, I mean, we'd like to see 2024 should have been closer to this 5,000 line, and 2025 should be a bit higher than that. But we can give them a down year or two. Dividend looks amazing. Like I said, they're growing it super fast. And then the price, balance sheet, pretty flat down here, but it's growing very slowly. Cash flows are the next to lowest value on average. Had a really good year in 2023. Aside from that, just kind of linear growth. And then we have earnings, I guess. I mean, earnings were right in line with the fair value in 2024, and analyst projections are really, really strong for this company. So we will see how they perform with that. Usually it moves pretty well in line. From 2022 to 2024, the fair value was very close to the earnings value. And then dividend, some great growth, kind of leveling off, but I did put in a bit of a lower percentage going forward. And it was in 2024 and 2023 very valuable for their value. And then finally we have the actual share price, which doesn't seem to have too much correlation with anything. I mean, everything was kind of clustered, and it was even higher back in 2021. It was very high in 2022, and then dipped down, while a lot of the metrics moved upwards. So 2023, the market moved opposite of the fundamentals, and then not much growth into 2024, at which point we saw even better growth in the fundamentals. I mean, there was a bit of a dip in the cash flows. Which brings us to 2025, where the share price currently sits right about at the fair value. And we are seeing good growth in the cash flows, in the fair value, in the earnings, and then just moderate linear growth through the dividend and the balance sheet. So all in all, I do like what I'm seeing with this thing. No massive red flags. The market definitely seems to like it, and it has super strong fundamentals. Outperforming expectations, market outperforming expectations. All in all, this is what we like to see. And I do think that it's at a reasonable price right now to at least start building a position, potentially consider one. I mean, you are outperforming the market a tad with what you're getting. And that's what a good time to start your dollar cost averaging is. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.